Hello investors, welcome to Simpli Stocks. Since the trade deal between India and the US was announced, we have seen a strong rally in some stocks. While the overall market has responded positively, US exporters are especially in focus right now. That is why in today's video, we will be discussing 4 interesting businesses for which the US is a major market and this trade deal is likely to benefit them significantly. Many people believe that India mainly exports textiles, but that is not true. India exports a wide range of products, and out of the 4 businesses we are studying today, there are 3 non-textile companies. So today's video is going to be quite interesting. But yes, as a standard disclaimer, this video is strictly not a buy or sell recommendation for any of these companies. Our only objective here is to help you understand these business models better. With that, let's get started. So about 5 months ago, we made a video on contra investing where we discussed 3 US export business models. If you have watched that video, you may remember that the theme of that video was that due to tariffs, many US exporters had corrected sharply and their valuations had become quite cheap. But if you would have been able to identify those companies that have strong cash balances, very strong balance sheets with low debt and differentiated product offerings, or say they have a moat or unique products, then these businesses can survive tariff uncertainty, and once tariffs get removed, they can perform well. One such export business was Garware High-Tech Films. Garware operates in the business of manufacturing different types of plastic films and sheets. For example, it manufactures automotive sun control films and paint protection films for cars. These films are applied on premium vehicles and protect them from scratches and sunlight, while also extending the life of the paint. Similarly, the company also manufactures architectural sun control films, which are used in large glass buildings and other structures. This is a specialty high margin segment for the company. Apart from this, Garware also manufactures shrink films, packaging films, lidding films, etc. for the packaging sector, which are low margin commodity type products. Around 25 to 30% of Garware's sales come from India, while the remaining majority portion, 70 to 75%, comes from exports. Here, US is the largest market, contributing about 40 to 45% of total sales. Because of this, tariffs had a noticeable impact on the business. If you look at Q3, that is the October to December months, the impact was at its peak. To counter tariffs, the management negotiated with their US dealers and decided to share the cost burden. Both the dealers and company shared the extra cost of tariffs so that prices would not increase for end customers. Otherwise, customers might have moved to competitors, leading to permanent loss of business. This decision impacted EBITDA margins, which declined from the range of 23 to 25% to around 18 to 20%. Despite tariffs, Garware still delivered, I will say, decent results. If you look closely, sales in Q1 and Q2 were around 495 CR and 570 CR respectively, while Q3 sales declined to almost 460 CR. However, Q3 is usually a weak quarter for the company because winters reduce the demand for sun control films in the US. So if you compare Q3 FY26 with last year, sales declined by only about 8 CR. So we can say, in other words, tariffs began impacting the business exactly when the weak season started in the US. Now, as we move into summers from January, February, demand for sun protection and UV protection films will also increase. And at the same time, tariffs have also been reduced. Earlier, management guidance suggested that if tariffs continued, sales would grow at 15 to 20% CAGR and EBITDA margins would remain in the 20 to 25% range. Now, with reduced tariffs, we can at least expect 20% top line growth and EBITDA margin of over 25% for Garware. And what's more, to counter tariffs, Garware's management started focusing on cost control. Additionally, the company diversified beyond the US and started building distribution channels in the Middle East. So going forward, these decisions will also benefit the business. Now, even though the stock has rallied sharply in the recent days, it is still trading at a PE of 30-32 right now. If we assume 20% sales growth and 25% EBITDA margin for FY27 along with margin expansion, then I will say the valuation still looks quite reasonable. So Garware is a business that you can study on your own. It is a strong, moated business with high product quality, patents, and in-house designed machinery. In September this year, the company is adding 600 LSF of PPF capacity for luxury cars, where margins are very strong. Next year, a TPU line is also planned, which should further improve margins. So over the next 2 years, we can expect strong sales growth and also margin expansion in this business. Now, just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simply Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video, and yes, also subscribe to our channel. The next business that we will cover is Pokarna. This is a proxy construction business, meaning it is closely linked to the construction sector. The company manufactures and exports premium quartz surfaces or slabs. Quartz is a type of stone, and quartz surfaces, as you can see on my screen, are these premium looking slabs used in high-end homes, hotels, offices, pubs, and bars. Around 85% of Pokarna sales come from the US. So tariffs had a significant impact on their business, obviously. Customers shifted to cheaper alternatives for kitchen and bathroom remodeling. As a result, Pokarna sales declined very sharply. In the September quarter, sales fell 53% year on year, followed by another 40% decline in the December quarter. Profits also declined, but most importantly, the company did not move into losses. So that is a good sign. The reason for this resilience is that Pokarna operates in the premium high margin product segment. The company reduced prices to retain business. Very few companies globally manufacture quartz surfaces of this quality and thinness. Pokarna has also recently installed new machines from Italy for Krios and Chromium technology for making ultra thin slabs. There is no other company in the world that makes such thin slabs. So Pokarna too, as you can see, has a differentiated product. After the recent rally, Pokarna is trading at a PE of around 30, calculated on trailing 12 months profits of 114 crore rupees, which includes tariff impact. If you instead consider last year's net profit of say 188 CR and assume similar earnings in the future, then implied PE on 3,500 crore market cap comes out to around 18 to 20. This is still a reasonable valuation, I will say. So Pokarna is another business that you can track, and broadly speaking, companies with differentiated products are better positioned to handle tariff related uncertainty. In the same direction, the third business we will study is Goldiam International. We covered Goldiam recently too on our channel because despite tariffs, the company has been performing very well. Goldiam very well navigated the tariff problem from April to September months. You will see that despite tariffs, sales grew by 41% year on year for Goldiam. In fact, due to tariffs, we are seeing margin expansion in this business. I will not go into too many details again because we anyways have done the business analysis. I will share the link of that video in the description. But since Goldiam is slightly unique business with a different product, let us briefly understand it. So Goldiam operates in lab-grown diamond or LGD jewelry. It supplies LGD jewelry to American jewelry retailers. Here, let me briefly explain what lab-grown diamonds are. So lab-grown diamonds are also real diamonds, but instead of being mined naturally, they are created scientifically in laboratories, and they are just as shiny, durable, and strong as natural diamonds. If a natural diamond costs you say 3.5 lakh rupees, a lab-grown diamond will cost you around 50,000 rupees only. So the price difference is massive. Demand for LGDs is growing rapidly in the US and other countries. In the US, nearly 50% of engagement rings today use lab-grown diamonds. In India as well, adoption of LEDs is increasing very gradually. Now see, compared to natural diamonds, since LGD jewelry is already a discounted product from customers' point of view, and if someone is buying an engagement ring or a gift, then they will still buy LEDs despite tariffs. So this is why tariffs did not have a major impact on Goldiam. And at the same time, management also handled tariffs very smartly. Earlier, the company used to cast gold and would do finishing and polishing in India before exporting it to US. After tariffs, what they have done, they have modified the supply chain. Now, initial gold casting is done in the US, then that product is shipped here. Finishing, polishing, and diamond setting is done in India now, and then the product is sent back to the US. So, this changed the product's origin to the US, and essentially, company is able to avoid tariffs. Now, what's more interesting is that this shift to US casting increased costs slightly. The company communicated this to their clients and raised prices, which has led to higher gross margins for Goldiam. So you see how a major problem was converted into an opportunity. And even though tariffs have been reduced, the company will continue using this US casting model for its bulk B2B business. LGD adoption is also increasing in India. Goldiam operates retail stores under the Origin brand and currently has about 12 to 13 stores. The company plans to open 45 to 60 more stores over the next 1.5 years, supported by a recent 202 CR fundraise. So Goldiam is another interesting, unique business which you can study yourself. The fourth and last business we will study is Kitex Garments. Kitex operates in the infant wear segment, and it is the world's second largest manufacturer of infant clothing. Infant wear is a niche segment where brands are extremely strict about product quality and safety standards. For example, chemical usage should be very low there. Plus, products are also highly customized. Over the years, Kitex has built very strong customer relationships, leading to a lot of repeat business. And because of such strict standards compared to other textile segments, infant wear offers better operating margins, and this is a segment that performs well even during downturns because people may cut spending on themselves but not on their children. Around 65% of Kitex sales come from the US, so tariffs impacted its business and this led to decline in sales. Now Kitex has a plant in Kerala with a capacity of, I remember, around 13 CR cloth pieces per year. Over the last 2 to 3 years, they have been investing around 3,500 CR to set up two new plants in Warangal and Hyderabad, which would have increased total capacity to 3.5 times. However, tariffs disrupted these plans. The Warangal plant, with a capacity of 16 CR pieces, was commissioned recently in September, but the Hyderabad plant was postponed to April to September this year. Work on that will be resumed when market conditions improve. At the same time, what happened was that tariffs reduced sales and margins also came down, while costs increased due to newly commissioned Warangal plant. As a result, the company went into losses. December and March quarter results are also expected to be weak only. However, now that tariffs have been reduced, I expect Kitex can scale up sales and profits very quickly. Existing capacity utilization is still low, and with the addition of Warangal capacity, the company has sufficient capacity for the next 2 years. After that, the Hyderabad plant will also come. Plus, because of high interest costs and operating expenses from expansion, an increase in sales will provide strong operating and financial leverage, leading to sharp bottom line growth. But see, the company has also taken a significant debt for this expansion, so the liquidity risk needs to be closely monitored. This year's repayment, I think, is around 10 and a half CR. That is manageable, but next year's debt repayment is more than 70 CR. So earnings growth will be very much important. When this video was being recorded, till then Q3 results, that is December quarter results, were not announced, and I expect company to post loss in Q3 as well. The market may react negatively, and that is when I am planning to take a small stake here. However, this is a very risky bet and you must do your own detailed analysis. Now before I end this video, a humble request: if you did not like the video earlier, please do like it now, and yes, you can also subscribe to Simpli Stocks. Your likes and subscribes motivate us to keep bringing such high quality videos for you every week. I'll see you in the next video. Happy investing.